The Wall Street snapped its 4-week gaining streak. All sectoral indices post losses. On this week's edition of Editors Roundtable, we put the spotlight on the $2.2 billion worth of block deals in June. We ask whether or not HDFC Bank is set to waltz, and the big opportunity in India's electronic manufacturing services sector. We'll be highlighting that as well. I'm Michael D'Souza, and joining me on the show today, Prashant as well as Nimesh. Hi guys, and we're joined by Mihir Bora as well. Mihir, thanks so much for coming down to the studio. Well guys, what a week it was, right? We were happy about the 4-week winning streak, but we couldn't make it 5.
We couldn't make it 5, and the worst part is we just missed out the all-time high by some 5 points or something.
By 1 point.
1 point. We planned for every day, right?
Yeah.
The guest with the graphics and everything.
Absolutely.
And it's still elusive. So I guess that was a bit of a disappointing thing.
Nimesh, it'll happen when we don't plan.
When we don't plan, yeah.
I think
that's the market, right?
I think good things, but they take their time. So maybe the market wants us to wait. And all through the week, I thought I was going to be the good luck charm. I came bak from leave and I was like, today we're going there. And we went within 1 point. I was like, damn. I could have taken some part of the credit. But Mihir, how do you see things shaping up? The markets, they were on steroids actually. So some bit of consolidation or a pullback actually could be healthy. Mid and small cap stocks were just flying out. How far away from that euphoric stage? Do you think it's getting a little bit frothy at certain parts of the market now?
Certain parts of the market, definitely, I would say. As you rightly mentioned, mid caps and small caps is one space I would be a bit wary about. But large caps still offer decent value. The big reason is that we've not seen the index cross the high seen about, say, 15 months ago, right?
Yeah.
So to that extent, we've seen earnings of the Nifty, for example, grow by almost 18% in the last 15 months.
Yeah.
So index being at the same level means that it's cheaper by 18%. So large cap like indices like the Nifty are still not that expensive. They're trading at average valuations. And if you look at some of the specific stocks, for example, 3 or 4 of the large banks, for example, they're still trading at price to book valuations which are less than pre-COVID. And these are really large banks we are talking about, right? So there is enough scope for stock picking. And I think the Goldilocks that we are in as far as India is concerned, where the peak of global interest rate hike are probably past us. Even in India, RBI is not as hawkish as it was 3 months ago. Inflation, WPI, etc. coming down, which means that we are in for an easing situation. And if domestic demand kicks in, I think it should be a good scenario for India.
Meet have given me a good base or a good platform, because later on in the show, I'm going to be talking about one of those banks that are still at a valuation that is lower than what it was during COVID. So, so we'll talk about them in just a bit. But gentlemen, what about you all? What do you all? Who's taking the trade setup today?
I mean, Nigel, you talk about the Nifty, right? We couldn't make it to the 5th week, but I think the action was small caps and mid caps, because small caps and mid caps gained for the 12th week, and we could not make it to the 13th because, after 12 straight weeks of gains, the index actually came under some pressure. And here is an interesting bit of statistic as well. And this is, I picked up some inspiration from an IIFL analyst and is a friend as well. So I basically looked at all BSE stocks, shortened that list by looking at companies which have market cap of at least 1,000 crores. Right, so there are 1,005 such companies. Actually, that statistic itself is quite incredible. There are only 1,005 companies out of all the listed companies in the BSE which have a market cap of over 1,000 crores. And then I looked at within this list companies which made a profit. Any profit. Because I wanted to get to the PE ratio. 251 stocks out of this 1,005 stocks on the BSE have a PE ratio as of today of more than 50 times. 50 times price to earnings ratio. So I think, that kind of tells you. By the way, I went back and looked at what this number was for the same group of stocks back on 31st of March. That was the low, and from when the rally started, it was about 15% had a PE ratio of over 50 times. So I think it just kind of goes to make the point once again that it's been an incredible rally. 63 stocks have a PE ratio of over 100. These are not small numbers by any yardstick. Now, just to come back to the Nifty itself, so as I said, for the mid-cap and small-cap indices, it's been the first pullback after 12 weeks of gains. The Nifty on Friday has closed exactly at the 20-day moving average, and that is an important level if you are trading in the near term from a positional point of view. We were highlighting that number over Thursday and Friday, 18,660, and we've, I think, managed a small close above it, just a couple of points or so. So it's neither here nor there. So you need a decisive move, and I think so we come back and look at it, what the market does on Monday and Tuesday before the holiday on Wednesday. Just one point on global markets. Rally in India has been very broad-based, and I think that's a great thing. In the US, it has been extremely narrow. It has been basically all these 6-7 AI stocks which have done very well. Not AI stocks, but stocks which have rallied on the back of the fact that AI is going to eat everyone's lunch. So the point I'm trying to make is it's a very narrow rally in the US, and the view on Nasdaq is very divided. Some say, well, it's going to go all the way, make new highs. Others say that it's ripe for a correction. The only question that is relevant for us is, if Nasdaq starts to correct, will it coincide with a correction here as well, as many believe one is due here in India as well? And I think we'll get the answers over the next couple of days or so. But on the Nifty itself, it's been a crucial close around the 20-day moving average. Mir, I just want to sort of ask you, are you in the camp which believes that maybe time for a, not a large pullback, but a decent pullback, which will give entry opportunities once again?
Certainly, pullback or a time correction, whichever way you look at it. Because as you mentioned, a streak of 12 weeks is quite a lot, and I always get scared when there is a continuous streak without any volatility, so to say. Because if the market's too steady and too trending, then you see this retail euphoria jump in a big way, and I think probably that's what we've seen in the small caps in the last few days. That coupled with the supply that you were talking about makes it a little bit of a cautious situation, I would
Somebody
say.
was joking that somebody sent a mail on, I think it was Saturday or Sunday. He said that, oh no, it's this holiday. How will the 1% daily compounding happen? It had become that kind of predictable,
Yeah,
right?
absolutely. Especially the small caps.
Especially the small
Yeah,
caps. But Dinesh, you're the blocks man, right? I mean, it's been raining blocks.
This whole week was all about blocks, right? Yeah. Every day, at least 2 or 3 blocks have got launched, right from Monday till Friday. Like even yesterday, we saw a launch of Landmark. So that was a week of all blocks, right? But again, as we said, we just missed out on hitting an all-time high by just 1 point. All the indices have corrected close to 1%. So again, a bit of a pullback from the euphoria that we spoke about. But as Mir spoke about, euphoria by the retail investors, I believe there is euphoria from the larger institutions. The kind of participation we saw in all the block deals, it was like just unseen of. I mean, we've not seen this kind of frenzy in the last many months now. I was talking to some large HNI investors as well, and even they seem to be a bit worried. The way the blocks are getting launched, 10% equity is getting changed hands. I'll go to the wall and explain in details about those blocks as well. But that was a bit of a niggling worry for a lot of HNI investors as well. I guess from a momentum point of view, we saw some bit of defensive back in the market. So pharma did well this week. End of the week, we saw some big moves in pharma names. And insurance was a big sector which came back very strongly. Some buying interest was back. We spoke to HDFC Life, and she was quite confident about FY24 overall. So insurance came back, pharma came back, but I think the big talking point or the big theme for this week was all about blocks. So let me just go to the wall and explain what will happen in the month of June. The number itself will surprise a lot of people. In the month of June itself, in the first 20 days, so to speak, the June is not even over, and we've seen block deals worth $2.2 billion. That's the amount of stake which have been sold in block deals by the larger institutions. I'll start with the bigger names first. So only yesterday, today morning that we saw, that was Landmark. The private equity sold 10% equity. Some big market names from the domestic mutual fund side have bought. So that is one large block done and done. The other large deals of this week includes the names like Piramal Enterprise sold its entire 8.3% stake in Shriram Finance. That was a large block. Sansera saw a large block deal wherein private equity sold 14% stake in a single day, and that got easily sold into. Even for a platform company like Delivery, Carlyle saw a clean-out trade where Carlyle sold its entire stake worth 600 crores, and they've moved out. But the big deal of the month of June was definitely HDFC AIMS. That was one of the large deals where Aberdeen has sold their entire 10% stake. And surprisingly, SBI Mutual Fund, a rival entity, so to speak, they picked up a large chunk, and they were anchor investors in that block deal. The other big surprising deal was Timken India. Even in this euphoria, a parent entity, Timken, sold out 8% of their stake, and they raised a lot of money in Timken India as well. Tim's was another stock, like something like CMS Info, private equity investors sold out 10%. Go Fashion, the Go Fashion block was launched on a Sunday evening, and Monday morning before the market opened, it got cleaned out as well. So these were the few large deals. I'll just mention about the BSE CDSL deal as well, where BSE sold out for 4.5% stake. That to some extent was largely because of regulatory issues, but otherwise it was largely the PE exits, larger funds selling out, and getting easily absorbed by domestic mutual funds and some large sovereign funds as well. So Mir is with us. Mir, I think Mir, you participated in one of the blocks as well. What is your sense? You've seen a 2 decade of markets. Are you getting a sign that this is euphoria now? This is getting to a different level, and one should be cautious?
Euphoria is there in the mid cap and small cap space for sure. Not so much in the large cap space, and some of the blocks are actually in the large caps. But if you look at the bigger picture, a lot of these blocks, not all, but a lot of these are from companies which IPO'd 1.5, 2 years ago, and now the original PE investors' lock-in periods have come to an end, and they have a choice of getting out. So if you remember, in the IPOs, most of the new tech IPOs, so to say, there was very little domestic institution participation. At that time, the concern was valuations. So the IPOs did not see much of a response from the domestic institutions. It was retail and HNIs who participated. But after that, a lot of these stocks have corrected 50, 70%. And you actually saw, even in the secondary market, some institutions start building up positions. So I think the difference is valuations. And some of these have come to attractive valuations. And anyway, PE or VC funds want to get out. So I think it's a healthy situation where there is supply, there is demand. Mutual funds and domestic institutions are sitting on cash. They anyway get $2 to $3 billion of SIP flows every month. So this $2 billion that you talk about, it probably a month of SIP flows, So it's big, but not so big in the scheme of things.
But Mir, I want to ask you. Nimesh is asking about the past week or coming week.
I think it's continuing. Not only the secondary blocks, but even anchor allocations for IPOs. A lot of the smaller companies are still looking for anchor allocations.
We talk about blocks all the time. For viewers, how does it happen? I mean, you get a call and you said we have this much.
It typically happens post-market to be executed the next day.
No, I mean, so you express your interest. I want these many shares, and they market for you. I mean, it's fascinating. I mean, right? And these are large amounts of stock which are sold together.
So typically, the fact that the blocks are there would be known for a few days because everybody knows who the PE holders are. Everybody knows the funds are.
That's how I get to know. Right?
And Nimish also keeps talking about it on TV. And broadly, since we cover about 200 to 250 stocks, we do have a view on some of the stocks in any case.
But
we can take a decision at short notice.
Yeah. But in the last few instances, most of the blocks have happened in the block window. Is that something which is a good sign that there is no leakage? It's for a dedicated buyer and a dedicated seller, and not at a large discount as well. Is that been one of the reasons that you participate in few of the blocks?
Certainly, block window is always more efficient because then the buyer and seller have control over the allocations, etc. So that's always more preferable. Of course, in the open market, you have the flexibility of probably getting a little more discount. But then it's in the market you can end up not getting your quantities because market's so liquid.
So Mir, I'll ask you about your preference for NBFCs. But before that, let's go to Nigel because he's put out a nice piece on whether this is going to be a time for HDFC Bank merger to get in place and whether HDFC Bank can really outperform. So, Nigel, give the numbers.
Gentlemen, we're talking about the music playing and everyone dancing. But you have to be careful, right? And you have to stand near the door in case the party ends, right? So, in that point of time, we're looking for some safety, good quality and well-run management. So, that brings me to the point. Is it time for the HDFC twins to waltz? Because they're going to be one in the coming weeks or the coming month or so. So, are they set to do a bit of a dance and participate in this party? Well, if you look at it in the last 3 months, on the last 3 years, you'll see that HDFC Bank actually has been a relative underperformer in comparison to the headline index and some of their peers as well. Now, in July 2023, we'll be getting the record date and we'll get, both these two entities that will come together. And the merger ratio as well has already been announced. The Nifty Bulls, in fact, will be hopefully they're going to waltz and going to be participating in this party or hopefully even leading this party. Because in the merged entity, they'll have nearly around 14.5 to around 15% of the index. And that'll have to perform to take the index higher or at least hold on to the index. You can't have a longer period of underperformance. But in the near term, there could be a couple of technical factors that could be weighing on the stock. One is a SEBI rule that a mutual fund scheme cannot invest more than 10% in a single security. So in the near term, that could be a bit of a headwind. Though most on the street believe there will not be such a large overhang on that front. The other problem was the street was baking in there's going to be an increase in the weightage in the MSCI reject. But that didn't happen as well, and that was a bit of a disappointment. But those are more technical factors. Fundamentally, the bank is looking rock solid, and let's break it up for you in 3 big points. they have stakes in, HDFC Life as well as HDFC AMC as well as HDB Fins. That value could be anything between 190 to around 220 rupees per share. Various analysts, they've given some, numbers out there. But out of the total share price, you'll see around 12 to 15% approximately is accounted for via these entities itself. So stripped of that, well, it's trading at close to around 13 and a half to around 14 times on a FY25 basis. Remember, 5-year average is close to around 20. So you're getting it at a bit of a discount. Even on a price to book value, well, it's trading at a discount in comparison to its 5-year average. So that as well, on this front, is looking relatively okay. And the return ratios are fairly good. The ROA and ROE is as well quite healthy for the bank of this size. This is the broad number that most on the street are working with. Well, finally, if you're convinced that, this is the way to play it and you believe that HDFC, the merged entity, will look up, well, then maybe HDFC Limited will get preference in comparison to HDFC Bank, because ultimately, you're going to be getting the merged HDFC Bank entity. And as of now, there is a bit of a cushion with HDFC Limited to the tune of close to around 1.7%. The big question is it time for them to join the party, and is the waltz on the cards? Well, Mir, let me post that question to you itself. At the start of the show, we were talking about a couple of those entities that are trading still not at the pre-COVID period. And this is one of them, I think so. What's your view? Is it time for it to waltz?
Well, I can't comment on individual stocks for sure. But as you said, there are only a few large cap stocks which are trading at bank stocks, for example, which are trading at below pre-COVID valuations. So that's the reason, as I was mentioning, there is some buffer for the Nifty to go up in terms of valuations because of these kind of structural factors.
All right.
Okay.
Let's just take a break, Nimesh. We'll come back on the other side. And we have one more very interesting piece that we'll put out, the electronics manufacturing services opportunity. And, we talk about stocks like Dixon, Amber, Sirma, Keynes, and what they've done April to June. I mean, massive rallies. But what's the play there? Nimesh will highlight that for us. Mihir, of course, stays on. We're back in just 2.
Well, I'm putting the spotlight on the electronic manufacturing services. It's called EMS. How big is this opportunity? A lot of stocks are buzzing in the last couple of months as well. In fact, last week we saw a debut of a new company called IQ Lightings, and that listed at a 45% premium to the issue price. And in fact, next week we're going to see another company which will issue, the issue will open for that. That is Cyient DLM, the demerged arm of Cyient, and the issue will open on June 27. So there is a lot of buzz which is going around in this particular space. So let's look at the bigger picture, the large picture, and how big is this opportunity. Globally, the market is expected to be $3 trillion by CY25, and it is growing at a 5% CAGR. Of that, the EMI pie is going to be the fastest moving pie. It's going to reach nearly $1.1 trillion by CY25, and that's going to grow at nearly 5.5%. Now look at the breakup of how the countries are panned out and where India stands currently. India currently has just a 2.2% market share in the global pie. That is going to go up by 4 folds to 7% by CY26. So the opportunity is quite big when you look at the global picture. Now look at the components which contributes to this whole big pie and what is in the radar. The traditional businesses are mobile phones, consumer electronics, and industrials to some extent. Now what will be the growth drivers would be the medical devices, aerospace and defense. That's where a lot of companies are getting into, and the clean energy. That's going to be the big drivers for this EMS plays going forward, and hence you're seeing a lot of action as well. Now look at the stock price movement and the valuation as well, because there is a lot of buzz as well. So I thought I'll put the numbers into perspective. So this year, if you look at the performance of individual stocks, Keynes Technology has nearly doubled in the last 6 odd months. Syrma Technologies is up close to 57%. Avalon is up close to 36 odd percent. But look at the multiples at what they're trading at. Just if you can go back and see, Keynes Technologies is trading at close to 52 times on FY24 price to earnings. Syrma is now trading at 45 times, and Avalon is trading at 40 odd times. Look at the other few names as well, which have been buzzing off late. Dixon Technology has been there for a while now. That stock is up 17% YTD, but it's still trading at close to 66 times on an FY24 earnings. Amber is trading at close to 36 times. Even that stock is already 25%. And as I spoke about the IQ, the new company which got listed, that's up 53% from the listing price. But keep an eye on the earnings as well, the multiples as well. None of the companies are trading less than 40 times. And while the opportunity is large, and there could be a lot of winners as well, but it's going to be challenging as well. And there are a lot of companies who are actually doing some CDMO work, which will actually benefit in terms of margins. But there has to be some valuation which looks like it's going out of the whack at this point in time. So let me ask Mir, you must have got exposure to some of these EMS companies as well. What is your take on the opportunity, and in terms of valuations, how are they looking to you from a near-term perspective?
Sure. So we have some exposure, not a large one. Sure. Unfortunately, we should probably have had more given the way stock prices are. But we were not sure about the valuations, as you mentioned. Valuations of 50-60 times does imply a huge amount of optimism in the share prices as far as growth is concerned. But to your question on opportunity size, I don't think there is much doubt on the size of the opportunity. It's just a question of how fast the companies will be able to ramp up their production facilities.
Mir, just sorry, one thing. All these companies, global companies which are setting up, Micron, Apple, is there any, because so far we've not had any of these companies, actually not many have started operations, there have been announcements. But is there a boost because of that also to these companies, or no? I mean,
see, once the biggies come in, they will set up their own supply and component ecosystem.
So these guys can,
unlisted and listed companies will be able to participate in the supply chain for the components ecosystem. Yes.
Okay, all right. Well, thanks, Mihir, for coming down to the studio and discussing all those sectors and giving us your insights as well in terms of the markets. And thanks, guys, for joining in. We're off to the weekend, and on that note, we'll wrap up on this edition of Editors Roundtable. Many thanks for watching. The news continues on the other side.